Hello, and welcome to Simplify Your Retirement Podcast with Steven Strickland. Hello, Steven.
Hey, Paul. How's it going?
It's going very well. Excited to be back in the studio today. Have a very interesting topic. So this season has been one where we've been talking about non-traditional financial products, plans, approaches to planning, just non-traditional, right? And so as with everything, because our focus is education, we want to make sure that as there are topics out there that people maybe hear about, people have questions about, that we address it and talk about it so that they understand not only what it is, where it fits, and all of that. Because as we've always talked about, we believe there's no such thing as a bad product, just a bad fit. Absolutely.
And that's where cryptocurrency and Bitcoin and digital assets definitely comes to the play. And that's one thing I was going to say. We have a foundational principle that we believe in. There is no such thing as a bad product, only a bad fit. So when it comes to commodities, gold, should a person own gold? There's no such thing. Should a person own gold? Some people should own it. Some people should not own it. It depends. Gold in and of itself is not a good investment or a bad investment.
Correct.
And neither is anything. Real estate, same with cryptocurrency, with Bitcoin, with digital assets. It's not a matter of whether or not it's a good or bad investment. It's whether or not it's a good or bad investment for you.
Yes.
And really, that's the key determining factor of making any investment decisions, which is why it's so important to have a plan when making any of these decisions. So that's actually a good way to start.
Yeah.
Because we're going to talk about cryptocurrency and Bitcoin, but should you own it or not, we'll get to that at the end.
And so last night I was teaching a class on Social Security, and we talked about the idea of a bad fit. And so just, we don't always talk about it. We assume, because we say it all the time, that people understand. But when I think of bad fit, I would think of, is cash bad?
Right.
No, cash is not bad.
Right.
The product itself of cash is not bad. But if my daughter, who's 23, investing in her 401k for her retirement, puts everything in cash, that's not the right fit, because she's barely keeping up with inflation. She needs to grow it. So that's a bad fit. So that's what we're talking about when we talk about a bad fit.
That's right. The plan determines the products. And what is the purpose of the investment? Where does it fit? Which is why you have to have a plan to see where it fits.
Yes.
It all starts and ends with that. So we're going to start with that, and we're going to end with it, believe me.
Absolutely. So when you talk about crypto, I know we've kind of teased this all season talking about how we're going to talk about crypto.
Yes.
So I think everyone's been waiting for this episode. I know you've been really excited to be teaching this episode.
Absolutely.
But there's a lot of information out there. And so as with anything, there's continuing education for us to make sure we understand it. And a lot of times with that education comes designations. So this year you spent some time getting a designation in, and I don't even want to say just crypto, but that's what people think of.
Absolutely.
So what was this designation that you got?
If you're able to view us on YouTube, you can see it here behind me. It's a certification in blockchain and digital assets.
Yes.
And so since there was such a thing, I thought I might as well have it. But ultimately, it comes down to being a fiduciary. It comes down to being a financial planner. So in other words, it's easy for a financial advisor to say, I don't understand it, so I'm not going to recommend it. I don't understand it, so therefore we're never going to talk about it. I just felt like I have an obligation to our audience on this podcast. I have an obligation to our clients to make sure that at the very least, whether or not we were going to recommend it or not, not just to simply say, well, we don't understand it, so we're not going to recommend it. I felt like obligated to make sure that as a financial advisor, as a fiduciary to our clients, I understood, and we were able to, our entire firm was able to understand what cryptocurrency is all about. Really, the whole asset class of digital assets. It's never going away, so we better be ahead of it. And so I felt like it was going to be valuable to our clients to make sure that I got this designation, and I'm proud to say that I've got it.
Absolutely. So it's blockchain and digital assets. So crypto is just a part of that, and I know we'll get into that. But
exactly. One other thing I think that's important is that, and again, if you're able to watch on the screen, we've got the 1040. Some of you are familiar with the texture. And the reason why I bring this up is because now digital assets, cryptocurrency, blockchain is so mainstream that literally on page 1 of every person's tax return in the United States of America is a question about digital assets. It says at any time, did you receive or buy or sell or exchange a digital asset? Yes or no? So literally, it's becoming so mainstream. It's like we can't ignore it anymore. And I think for a lot of people, people are looking for good advice because if you don't have financial advisors, if you don't have fiduciaries, if you don't have qualified professionals looking into this, it's like the Wild West. And people can be sold things that they don't understand, believe it or not.
Yeah.
Yeah, shocker. There may be people out there that sell things that are fraudulent. There may be people that try to take advantage of other people, because no one knows enough about it. People get taken advantage of. And the problem, even in cryptocurrency and digital assets, is this has happened over and over and over again. People have been, defrauded, lied to, swindled out of cash. And so you got to be careful to make sure you understand it properly. It is becoming mainstream. It will, but you just got to know what to actually own and not own and who to believe and not believe.
Absolutely. And I know that, the IRS has put this out there, and so they're starting to monitor this.
Yes, absolutely.
There's regulation being talked about, even in the securities division of things. They're still trying to get a handle on this.
Absolutely.
And so it's still new enough that they're starting to ask the questions, but not necessarily are they talking about everything. And so it is important to know.
It's important.
Yeah.
And I just threw up here, some of the basic terms. And I'll just start by just saying, I don't always bring notes, but when I do, I bring a lot of them and I wear my glasses. So I don't normally bring notes to the podcast and I don't normally wear my glasses, but here we are.
Yeah.
But I think it's important. What I wanted to just start with is just some of the terms that are out there. Because a lot of people don't understand just the basic terminology. You hear these terms, a lot of people are using them interchangeably.
Yeah.
And I mentioned when I taught, we did an entire educational event for our clients where we talked about these things. And I said, it's like trying to describe something, it's like trying to describe a cell phone, let's say in 1980, an iPhone, and what all the capabilities that it can do, a camera, a computer, all these things in one device when it's not there yet. And that's kind of like what this is like.
Yeah, it is. And it's, very similar to that would be someone saying crypto is like saying vehicle, right? There's all different types of things. And that's why I pointed out earlier that the certification you got is for digital assets, not just cryptocurrency, but a lot of people equate crypto to everything in this space.
Right.
And so as you unpack this for us, I think we're going to see that there's not just the digital assets themselves, but there's everything behind it, just like there's people who make the cars, and there's the plants and the manufacturers, and there's the people who service it, and all of that. And so, so what are some of these terms that people need to understand?
I think it's a good analogy saying the word vehicles. So if we had a show today, let's talk about vehicles. I mean, where would you begin? Where would you end? How long would this show last?
Yeah.
Same thing with let's talk about digital assets. Okay. We're going to be here for a few days.
Yes.
But there's a few key terms. Again, what I'm going to look at this as, this is 101.
Yeah.
Yeah. So definitely I just want to talk about some of the basic terms. We're not going to go deep. We're just going to talk about just some of the generic terms, the general terms, so people have a basic understanding. So the first one is cryptocurrency. So what is a cryptocurrency? It's a digital, encrypted, and decentralized medium of exchange. Cryptocurrencies are crypto for short. They are digital currencies that allow people to make online payments without the use of third parties. That's simply what it is. It's a digital currency. They are decentralized, meaning they are not issued or governed by a central authority like a bank or a government. In other words, they are underpinned by cryptographic systems and operate on a public ledger called a blockchain. So cryptocurrencies first. It's just a medium of exchange that is digital, but they operate on a blockchain. So what is a blockchain? A blockchain is basically a digital ledger that once data is entered, it cannot be altered. It is called distributed ledger technology. It's distributed in the sense that it's available to anyone with an internet connection. It is public. Anybody can see it at any time. And it's immutable. It cannot be erased. It cannot be changed, copied, or altered. And so all of this data is encrypted using hashtags. It's linked together. That's what a chain is. All this data is linked together in a chain, which in essence eliminates the need for an intermediary or a trusted third party or a middleman between buyers and sellers. All the data is there. So if, for example, if I'm going to go buy a house today, if I'm going to buy a house from you, you're selling your house, I'm the buyer. We have to go to a title company. The title company is going to verify that you owned it first, and then you're selling it to me. Where in the future, where a blockchain comes into play, it says that, this blockchain knows that you own this house. The blockchain knows who I am. The blockchain will verify my identity, your identity, make this transaction, and we won't even need this supposed intermediary.
Yeah.
So potentially that's where the technology is going to come in. It's decentralized. You don't need basically a third party. It's going to be accurate. It's going to be trusted because it's distributed all over the place. If someone was going to, you can't change it, but even if you could, you'd have to change it on multiple hundreds of thousands of nodes or computers around the world. Which almost makes it impossible to alter.
And that's where blockchain technology really shines is the validity of the information, right? And it's easy to see, and you can't mess with it. And so there are people who wonder times, right? How do I know that this information is true? And that's where blockchain technology comes into play.
So there's a lot of potential, uses for it.
Yeah.
It's transparent. There's no, it's limitless. It can allow for greater speed.
Yes.
It's authenticated with cryptography. There's a lot of very powerful things about it. And so in the future, potentially, can you imagine, basically, no ticket resellers, you maybe no Ticketmaster. You can go directly from you to them because it's trusted. It's decentralized. We can cut out the middleman. Maybe no Airbnb. It doesn't mean you can't rent your house out anymore, but we may not need the middleman. You may not need Venmo. You may not need Uber, these actual companies. And dare I say, my biggest hope of all is maybe there'll be no need for the DMV. You have the title of your car. You have the insurance of your car. You need to, update your tags. You can just do it. All the information is available. All the information is transparent. You don't need any third party. So there's a lot of potential, uses even in money transfer, wire transfers around the world, financial services. Even in our world of stocks and bonds and mutual funds, a lot of times it takes 3 days to settle a trade. And that is normally because it's verifying the parties involved. It's verifying the data. And so this is going to be a lot faster. So the speed of financial transactions, the lower cost of financial transactions is really one of the benefits of blockchain.
Yes.
But you cannot invest in blockchain. It's just the underlying technology. So the overall category of blockchain, cryptocurrency, tokens, all these things is what we call digital assets. And this is important. And what I want to tell everybody is, just like the other asset classes, everyone's familiar with asset classes. When I say that, I mean stocks is an asset class, bonds, fixed income is an asset class, real estate, commodities. All of a sudden, now there's a new asset class. It's the first new asset class in over 150 years, digital assets. And so that's where it came into play for us. We had to say, look, there's a new asset class here. That generally means it has a different set of risk features. It has the potential to, add correlation to a portfolio. It has the potential to add maybe risk, but also return. So it's something very important for us to look at. Like any asset class should be considered in a diversified portfolio.
Yes.
So you don't invest in, you can't go out and buy blockchain. You can't go out and buy, a blockchain, stock. It's just the underlying system, the protocols, the technology, the industry. This ecosystem is just runs on a blockchain. So what runs on a blockchain? So the next one is Bitcoin. Everyone's heard of Bitcoin.
Yes.
And Bitcoin basically was the first and is still by far the biggest in terms of market share. It is Bitcoin, capital B, Bitcoin. So Bitcoin is just a peer-to-peer electronic cash system. So you take all those terms by itself, peer-to-peer. That means it's between you and me. When when transacting with Bitcoin, we're not going through a bank. I have the coins and I'm paying you. You're accepting them. So peer-to-peer, it's electronic. It means there's no paper involved. It's a digital asset. It's cash. It's a way to purchase things or buy things from each other. And again, it's a complete self-contained system running on a blockchain. It's verifiable. It is, immutable. So people like using, Bitcoin as a means of transactions. And that's really why it was created. It was created to basically say, let's eliminate government control or centralized authority over transactions between people. And the problem with that would be that you can't trust it. Whereas now it's on a blockchain, you can trust that it's going to be accurate, that it's going to be, something that's transparent, all these sorts of things. So that's a good thing. So Bitcoin is this lending system, or this cash transaction system, capital B, but then to transact business on capital B Bitcoin, which is the blockchain, you have to buy and sell lowercase b Bitcoin, which is actually the tokens, the coins that operate on the capital B Bitcoin blockchain. What is Bitcoin? Bitcoin itself, lowercase b, is something that's 8 decimal points. So it can be divided all the way into 8 decimal points, which allows for very, very small portions. So it's going to allow for micro payments, micro lending. It's important for people around the world. And Paul, it's hard for us, I guess, in the United States even to imagine people that don't have cash or people that don't have bank accounts.
Yeah.
But I've traveled around the world. I've done a lot of mission trips over time. What a lot of people still have is a phone.
Yeah.
Okay, and so what allows people to do who don't have cash, don't have a bank, they can't go to a bank and open a bank account, they're still going to be able to buy and sell using Bitcoin, because you can buy 0.00000001 of a Bitcoin, 8 decimal points. It gets to very small numbers, and you're able to transact business that way. So it's going to allow commerce to spread around the world. That's one of the potential benefits of having an electronic cash system.
Yeah, and so when you talk about it, like even worldwide, and you're talking about going down to 8 decimal points, it's no different than what we have now with our current currency system, right? So I could have $100 bill or I could have a penny.
Right. That's
and
right.
So what I'm doing is I'm between pennies and nickels and dimes and half dollars and silver dollars. All I'm doing is I'm dividing currency down, and we see that worldwide.
Right.
And so this is something that translates across all systems to be able to have one even mode of currency, basically,
and it's going to allow, again, like I said, for people in these that don't have cash or don't have a bank account to actually do commerce, and to be able to open up. And we're not talking about millions; we're talking about billions of people around the world. That's going to allow all of a sudden a way to transact business and do more things. So, but what is Bitcoin, lowercase b? This has been the big debate. It's on page 1 of the 1040, right? So, what is it? Does the government look at Bitcoin as money? Is it a currency? Is it a property? Is it a security? Is it a commodity? And honestly, no one still really knows. I mean, basically Bitcoin is classified as a commodity still. The IRS views it as property, which means that if you own a Bitcoin, lowercase b, or any token, and you own it for less than a year, you're going to pay short-term, capital. You're going to pay short-term gains, and you're going to pay regular income tax. If you hold it longer than a year, it's long-term capital gains. That's how the IRS looks at it. It is not regulated by the SEC or the Commodities Future Trading Commission, but it's actually, it is regulated by the Commodities Future Trading Commission. So it's still not an SEC investment. Okay, but is it money? Money, the definition of money is that it is a store of value, a unit of account, and a medium of exchange. So in that sense, it can be considered money. But the problem with Bitcoin, you know what the number one problem with Bitcoin is?
What's that?
It is volatility.
What?
Yes.
No.
So in other words, Bitcoin can never be the ultimate means of exchange between people, because it is really based on supply and demand. There is no intrinsic, there is nothing that it boils down to in terms of, say, a dollar or a piece of gold or an ounce of gold or anything like that. And so if you wanted to sell me your nice sweater you're wearing today, and today it's worth, in dollars, X amount of Bitcoin, I could buy that from you, and tomorrow that Bitcoin could be dropped in half, or it could be worth double that. So no one's going to use it in regular commerce unless, it's tied to something stable. And that's really where what we're going to talk about next is stable coins. A stable coin is a digital asset that's linked directly to a fiat currency like the US dollar or gold. And so now all of a sudden, people are talking about stable coins. And the central bank, I do believe there is going to be the next one, which is the central bank digital currency, which just means digital money issued by a central bank and backed by a sovereign government. So I do believe that, distinguished from Bitcoin and other digital assets, this will actually be a blockchain or coins that you can buy backed by a sovereign government, basically tokenized fiat money. Instead of carrying a US $1, I can carry a central bank digital currency that is worth $1. So the advantage of that is then it will allow what I said at the beginning, all the stuff about blockchain, peer-to-peer transactions, no middlemen. So it's the same technology. The difference is if I bought that sweater for you for $50 and it's not Bitcoin, it would be a $50 digital asset backed by the US government. So it's worth 50, I know it's worth 50, and we could do it like that. That's the difference. So I do believe I'll make this point clear, even though I just said lowercase b Bitcoin, I don't think can ever really be a means of exchange. It's too volatile. It's too risky to buy and sell in Bitcoin. And everyone's probably heard the story about the guy who sold, two, Papa John's pizzas for, I forgot how many Bitcoins. Now the guy's multi-millionaire. I mean, just because no one knew what it was worth back in the day. But the point is, there will be stable coins. That means no volatility. It will be a central bank digital currency instead of carrying actual dollars, which can be stolen, which can be left in the car, which can be, whatever. This is going to be a digital wallet, transactions, which, will be valuable.
Yeah. I like going back to what we talked about at the very beginning. This is an asset class. Right? So even when I'm looking at that and hearing that, I'm hearing there's some stable, just whatever the market says it's worth, almost like speculation, where it's it's Bitcoin. It's based on whatever the value says, whatever people say the value is. And so, but just like with stocks, there are safer stocks and there are riskier stocks. And so everything in between. And so this
is really going to be like you're saying. So in other words, Bitcoin is more of, you can buy and sell it as an investment. Central bank digital currencies won't be. It'd be like, unless someone's like investing in cash, which most people don't invest in cash or play that game. You know what I mean? But that would be the difference. These tokens will not be something you invest in or buy and sell, try to make money on. It's just tied to a cash dollar amount, which would be great. Then there's tokens. Tokens are just shares. There's a lot of talk about tokens these days. And a token is just a share of, a piece of the pie. We're all used to buying shares in stocks or mutual funds or ETFs. That's what it is. Sometimes tokens are used as a utility token. Think of like subway tokens or airline points. Those are tokens. But then there is going to be, so again, we're talking about something that's not here yet, but it's based on this underlying technology, this field of digital assets, a security token. So let's just say, Apple stock. If someone today owns a share of Apple stock, it is digital, it's on paper, you know what I mean, but it's not a token, even though that's technically the same sort of term. But we know you can buy, like, for example, Apple, you know what I mean? I forgot how many millions of dollars, or Amazon, how much this is worth. Millions and millions of dollars. You can't own that, but you can own a tiny fraction, a share.
Yes.
Now, all of a sudden, in the worlds of tokens, it takes something that's a real asset. And what is a real asset? We're talking now about real estate. We're talking about fine art, things that normally in the past you couldn't own just a share of. someone could literally take, the Empire State Building in New York and say it's for sale. If you wanted to buy the Empire State Building in New York, I believe it's worth $2.3 billion. Okay, no one's going to buy that. But what if the guy who owns the Empire State Building in New York worth $2.3 billion said, I'm not selling it, I'm going to sell it in shares, just like Apple, just like all these other things. Now, all of a sudden, it's going to open up the opportunity to invest in new things because you can take real assets like real estate, like art, and now all of a sudden, someone could sell shares of it.
Yeah.
Portions of the company, but not in shares, but literally in tokens through a blockchain, a digital asset, a real purchase of a share. I think that'd be cool.
Yeah,
and so owning
you're
parts of these real estate.
Is it similar to right now? People are becoming used to crowdsourcing or crowdfunding.
Yeah.
Right, where someone's investing in a company because they have this idea, and then they get something in return for it.
Right, exactly.
And so this is just saying, I'm going to invest in it that way.
Absolutely.
And so it's going to open up a whole bunch of
sudden,
options.
it's a real asset.
Yeah.
You can own a part of that real estate where people are paying the rent. Now you're getting part of that, or if it grows in value, just like anything else. We're talking about anything. Vintage cars, art, real estate, all these kinds of things that before could not be monetized. People had one option, sell the whole thing, but now they could take half the value of that building and sell half of it out, and people can buy and sell it and transact in it. So it's going to open up a whole new world of opportunities. That's tokens, that's shares, that's a digital currency that's going to be bought and sold through one of these blockchain technologies. And then there's non-fungible tokens. I just want to say this real quick. That just means it's a unique, one-of-a-kind, not reproducible. Just so normally a non-fungible token is different in the sense you're not owning the actual building. You may be owning something that there's only one of. So it is risky. It's not the actual asset. You don't actually own shares in a thing. It could be a picture. It could be a picture of a picture. It could be, someone's likeness, those kinds of things that people are buying and selling. So I think you got to be careful with, NFTs. The only thing that's good about them is that, there is always going to be one. It's one of a kind, not reproducible, those kinds of things. So,
okay. And so it was good that you brought out the definition or the initials, right? Because I think there are people that are watching this and listening to this right now that have probably heard of NFTs.
Yep.
But they've not heard of non-fungible tokens. And so realizing that's what it is.
Yes. Most people just say NFT. Yeah. Exactly. So again, they're tokens, they're coins on it. You buy and sell NFTs on a blockchain. But they're risky in the sense it's not like buying a token of a real estate or a share in a company. You're not part owner of the actual real asset. You're owning a replica, even though there's only going to be one replica of that thing. So just be careful with those.
Yeah.
But what about the opportunity? So again, that's what it is. We know it's here to stay. Web 3.0, digital assets. It's the future. So how can someone invest? You always want to be ahead of the game.
Yes.
You want to invest in things that are going to be there before they become mainstream. And so, a couple of things to keep in mind just about digital assets. It definitely involves high risk. So we would tell people now, because it is still kind of new, and we don't know, which technology is going to become mainstream, which company is producing the blockchains and the protocols that are going to be the one we're all going to use. So, like with everything else, only invest what you are willing to lose. That being said, adding small allocations to risky investments in a portfolio, if held over a long period of time, can add significant upside potential returns without a lot of downside risk.
Yeah.
Anytime you add something risky to a risky portfolio, sometimes it adds to the returns, but actually lowers overall risk because now you added a different asset class in there. Adding asset classes to a diversified portfolio generally, reduces risk.
Yes.
And so in the world of investing, what we're looking for in risk, just to be a little bit technical, and that is we're always looking at standard deviation, which in a diversified portfolio, you want it to be lower. Mm-hmm. We're looking at a thing called the Sharpe ratio, which you want to be higher, and you want there to be no correlation or very low correlation between all the asset classes in the portfolio.
Yes.
So what happens when you add digital assets to a diversified portfolio. So Paul, let me just ask you, when we're looking at the world of investing, if someone had like a 60-40 portfolio, what do you think is the normal, rate of return that we can expect in a 60-40 portfolio?
60-40 portfolio, you're probably talking about 6-7%.
Right.
Yeah.
7%. So, let's assume that if you have a typical portfolio, 60-40, you get 7% per year. But what happens if we add a 1% allocation to cryptocurrency or to Bitcoin in a portfolio? So instead of 60-40, we have a 59-41 mix, which means 59% stocks, 40% bonds, 1% Bitcoin. In 2017, Bitcoin rose 1,500%.
Is that
okay? In that 1 year.
Wow.
The following year, 2018, probably after everybody got in, Bitcoin crashed, losing 84% of its value in that 1 year.
Wow.
So what happens if you have a portfolio where if you were in a 60-40 portfolio, let's say in 2017, you got 7%. What if you had Bitcoin 1%? In 2017, when it went up 1,500%, your portfolio return would be 22% that year.
Wow. Just
by owning 1%. But what if that Bitcoin went to zero? You bought 59% stocks, 40% bonds, 1% crypto, and it actually goes to zero. The 1% becomes worthless. Your return is actually 6%.
Okay.
So in other words, it's not a major downside risk. If I didn't have it, I would have gotten 7%. If I did have it, I got 6 and went to zero. But if it went up like it has gone up, it's possibly 22. Now you look at this the next year. The next year, 2018, Bitcoin went down 81%. What would have happened? My 2-year return on a typical portfolio would be 14.5. My return on a 1% allocation to Bitcoin when it went up 1,500% 1 year, down 81% the next, my 2-year return is 15.4. So still higher than not owning at all. And if it actually went to zero, my average rate of return or my 2-year return would be 13.4 instead of 14.5. So again, ultimately the point is, and this is from Rick Edelman's book, What About the Truth About Crypto. He talks about this 1% allocation, what it can do in a portfolio. There's really not a lot of downside risk. There's a lot of potential, good return. I said earlier, Paul, you want your Sharpe ratio to be higher, your standard deviation to be lower, in your correlation to be about the same in a diversified portfolio. Here's an example if you're able to watch us on the screen, watch it on YouTube. This is from January 14 to June of 2021. If you had a 60-40 portfolio versus a 59-41% allocation to Bitcoin. Average annual return with 1% Bitcoin, 8.9%. Without Bitcoin, 7.8. Sharpe ratio is higher. Standard deviation is the same. The worst case scenario, the worst 1 year return is about the same. So ultimately, we've looked at this over and over again, and we found that basically a 1%, somewhere between 1 and 5 at the max, 3% is not bad, but certainly there is a case to be made to add in a diversified portfolio of multiple asset classes, adding in a new asset class, digital assets, even adding a 1% allocation to this new asset class, digital assets in Bitcoin, the potential upside is so much greater than the potential downside. It's worth it to have it in a portfolio.
Just make a note that when you put that 1% in, where you're taking it from in a standard portfolio.
Yes.
So you're not taking it from the bond portion, which is typically your safe money portion. You're taking it from the stock portion, which is the riskier portion.
That's a good point. So we're taking it from something else that's risky, moving it to something that's a little more risky.
Yes.
So instead of 60-40, 59-40 in one. That's exactly right. So, but with all investing, I think, Paul, I think it's important to end where we began.
Yes.
And that is, sometimes people hear about digital currencies almost like they hear about any other supposed new asset class where people got wealthy very fast because they hit it at the right time.
Yeah.
They found some needle in the haystack, and that's a possibility. But there's a big difference between speculating, gambling, and investing. Investing is something that is known. There's a high likelihood of return. Speculating is something that's kind of unknown. There's nothing wrong with speculating as long as you're only investing that money in something you can afford to lose.
Yes.
Gambling, we don't recommend. That has a very low likelihood of success. The opposite of investing. Something real, high likelihood of success. Gambling, very low likelihood of success. Don't gamble, invest. Speculation, somewhere in the middle, it has the potential for return. So when someone's going to speculate, we would say, is that wrong? No, but just be prepared to lose the money. Don't be emotionally involved. Know that you can afford to live without that money. It's not going to impact your plan for retirement.
Yeah, and most people, if you were talking about, when you're talking about, say, a 1% allocation, most people, when they look at their assets, go, 1%. They don't bat an eye if they lost 1%.
That's right. Exactly. So in a diversified portfolio, that's where we say, hey, we're gonna do this in our portfolios because there's a lot of rationale behind it. But the real issue comes in when people outside of have money that they're investing in these things. You know, I've been to the gas station before, and I literally see vending machines where you can buy Bitcoin. Okay, Bitcoin can be sold 24/7, 365. You can do it, you know, in the middle of the night. You can get up and buy. So you just got to be careful. This is where I'm saying you have to be careful. It's not. Hopefully, if you have an advisor, hopefully, if you're doing it in the context of a plan, it makes sense in a 1% allocation. It's when you're starting to buy and sell odd coins, tokens, trying to get rich quick. Someone could take $1,000, put $100 in 10 different coins, and just hope to strike it rich. If you want to do that, is that wrong? It's not wrong. Just be prepared to lose that $1,000. Don't lose sleep over it. Don't watch it every day. Do it. That's what speculation is. I have money that I can afford to lose, and instead of buying this, that, or the other, I'm going to do this. That's okay. And potentially one of them does go off, and that's great. That's what speculating is, and there's a place for it, but not with your real money, not with the money you saved and invested for to get you to retirement, through retirement, we would say that. But there's some important principles. I have them up here on the screen. The plan determines the products. Where does it fit in the 3-bucket approach? Is it a liquid investment? Is it an income investment or growth? I would just say it is liquid, which is a good thing, but it would be more the growth bucket. It's not for income for sure. I would not count on a Bitcoin investment to produce an income stream. Always remember the 5-year rule. It's the same with everything. Sometimes people forget the rules. If you really want to make money actually in Bitcoin, if you actually want to make money in a digital asset, in a cryptocurrency, it's still the same rules apply. Investing is a long-term strategy. Long-term is 5 years or longer. So intend or plan to own it for 5 years or longer. If you're investing money into a Bitcoin or cryptocurrency and you need that money within 5 years, Bitcoin is not the place to put it.
Yes.
Cryptocurrency is not the right fit. It is an investment, just like all your other stock investments. You should only invest money you don't intend to need or want for 5 years or longer. Don't do it alone. This is one place where people try to I'm just gonna do this on my own. If it's play money, if it's money you can afford to lose, maybe that's okay. But otherwise, get real advice. And it's because there is a lot of fraud out there.
Yeah.
And it's not entirely regulated yet. And so that's why the last point on here says go mainstream. The SEC has approved many Bitcoin ETFs. So there are some funds that you can buy, through major firms, brokerage firms that have been approved by the SEC as an ETF. And so we would just say you're safer to buy one of these ETFs that has been approved by the SEC, not endorsed, but it means that they've allowed these ETFs to go forward where you can buy and sell in a public, through a public custodian like Schwab.
Yeah. And so really this advice, it doesn't change from anything that we've talked about over the past 6 seasons and what we talk about day in and day out.
That's right.
And it really has to do with the plan. And the plan is what helps you avoid the 2 most common issues that where people make mistakes. And what are those?
Definitely fear and greed. So don't buy Bitcoin because you're afraid of missing out. Don't buy it because you're greedy. That's a mistake. And there's really 2 ways to make money in the stock market. And same with Bitcoin, same with cryptocurrencies. These principles don't ever change. You need time and you need discipline.
Yeah.
If you want to buy, Bitcoin in the morning and sell it at night, that is day trading. That's not investing. So just be careful of those two things. If you want to be truly successful, you need time and discipline.
Yeah. And so that's the key. It comes down to the plan. And when you say don't go it alone, I also think of the fact that even early on, you were talking about here's where we've been, here's where we're at. And I think about some other things of, kind of like the cell phone analogy, what they used to be like, what they are now. And it's based on technology. Right. And so this is going to be an ever evolving. And as the government and different agencies start to really get a handle on this, how do we define it? We're going to see growth. Right. We're going to see opportunities exist. And so, but if you're trying to do it alone, you might miss some of those opportunities. Right. You might get in the wrong opportunities. And that's where doing everything in the context of the plan and looking at mainstream and doing all of that, not doing it alone. Right. But seeking advice. That's right. That's where this is key.
Yep, and that's where wisdom comes in. Yeah. And that's what we're about here. First, wisdom, then wealth. The ultimate guide to investing in crypto. Here are the principles to keep in mind. 1 to 5% allocation. 2.5 to 3% may be the sweet spot. Dollar cost average in. You don't have to go all in at once. You can get to 2.5 or 3% in crypto or digital assets slowly. Minimum 5-year holding period. That's the way you need to think about investing. Still, you want to annually rebalance. Just like any other investment, you want to make sure your allocation maintains a 1% or 2%, whatever the target is, and make sure that your crypto investing, digital assets investing is in the context of a plan and within an overall diversified portfolio strategy. We want everyone to be free to give, serve, and enjoy life. So buy it, invest in it, go to sleep at night. If it's keeping you up at night, if it's causing anxiety or frustration or any of these things, you shouldn't own it. Yeah. Any investments you own should lead to peace of mind because it's done with advice, it's done in the context of plan. It doesn't change just because now it's available 24/7, 365. You can do it by yourself.
Yeah. And for those who maybe this is the first time watching this or hearing this podcast, you probably haven't heard this before, but for anyone who's been along for the ride so far, you know that one of the things we always close with is financial peace comes from having a plan. And that's it. I mean, that's really it. I've seen people, and we've read the stories of people who are so worried about their Bitcoin. And what if I lose my, all this stuff that happens. But when it's done siloed, that's where the issues come in, and that's where everything breaks down. And so having a diversified approach, having a systematic approach, a wise approach, within the context of a plan is going to eliminates
the fear. Yeah, it eliminates the greed. Investing shouldn't cause anxiety if it's done for the right reasons, right purpose, right fit. It's a blessing and not a curse, and that's what we want this to be.
Yes, absolutely. And ultimately, like you said, at the end of the day, it's so that people, when they have that peace, they are free. They're free to be able to go give. They're free to be able to serve, and they're free to enjoy life. That's what it's all about. Right. It's not about how much can I make because we can't take it with us.
Right. Yep. You should own these investments. These investments shouldn't own you. Yes. In other words, it shouldn't own your time. It shouldn't own your ability to enjoy life. You should own these things because you believe in it. You see where it fits. You've got a good allocation to it. And then go do the things that you're supposed to be doing to get not just a return on investment, which we like to talk about, but a return on life. That's what we're all about at Y as well. That's what this podcast is all about as well.
Yeah. And so for you watching, if you're watching this on YouTube or you're listening to this on the podcast, it all comes down to, again, having the plan. And if you don't have a plan or you think you have a plan, but you're not sure, you have questions, that's what we're here for. This is what we do day in and day out. We meet with people to be able to help put together a plan that gives them the freedom to give, serve, and enjoy life, that gives that financial peace. And it's a simple step. There's a few things that you could do to start that process. One would be call our office at 816 246-9473. And we will start with just a simple 15-minute phone call just to be able to understand what your concerns are and talk about how we can help you build a plan that is right for you. You could email us at info@wisewealth.com. That's info@wisewealth.com, and request a copy of Stephen's book. These timeless principles that we build the plans based on, that we do our planning based on, are all within that book. So request a copy of Stephen's book, Simplify Your Retirement. You could go to our website, wisewealth.com/events. If you're local to the Kansas City market, we have events all the time coming where we continue to educate people and come to a Simplify Your Retirement class, come to a single topic class, come to a big event that we might have where we bring a nationally known speaker in to be able to continue to educate our clients. Whatever it is, though, the key to all of this is to not just take this information and go, wow, I feel smart now. It is to do something with it. So education is good, but we want people
Wisdom
to be able to
better.
take it and apply it.
That's right.
Right?
That's wisdom.
And so take the next step, whatever that is. And maybe the step for you, because you've worked with us over the years and you have a plan and you are giving and serving and enjoying life right now, maybe the next step for you is simply to share this with someone who doesn't have that freedom that you have. Very easy. On the YouTube, you click that subscribe button. It will notify you when a new episode comes out. On your favorite podcast channel, subscribe, download, like. All of these things help get this information out there, but then it also notifies you when new episodes come out, and it makes it easier for you to share this valuable information with others. And so, Stephen, again, thank you for investing in our clients, investing in our audience, the ones who are consuming this information that we're putting out there, for taking the time to get this designation and be able to help try to explain it so that people understand where it is, to be a fiduciary for our clients. Thank you for all of that. And thank you for your time. Again, our last thank you goes to you, our listening and viewing audience. You're the reason we do this. Without you, we wouldn't be here. And so we do thank you for tuning in. Again, like, subscribe, share this information with others. Again, Stephen, this is Paul from Wise Wealth, reminding all of you that financial peace comes from having a plan. And we'll see you next time.